a great time tonight, and I look forward to seeing the feedback from the members sometime tomorrow.
Yeah, thanks again, Peter. Really appreciate you calling in.
Okay, mate. God bless you, guys. Bye-bye.
God bless. Bye-bye. So thanks to Peter Murphy, the CEO of Christian Super there, who often introduces the session, and it's much appreciated from my perspective. Just before we get started, I do need to articulate that tonight's presentation is advice of a general nature only. Do not take it as personal advice. It is general advice only. If you do want personal advice, then we can provide that to you. The process that we normally take you through is to have you complete a questionnaire. Then we meet with you for an initial consultation where we understand your goals, your current situation, and talk through the pros and cons of the range of options. If it's worthwhile, then we can provide a statement of advice for you, so written recommendations for you. We can help you implement that advice and provide ongoing review and monitoring. Throughout tonight's session, we're going to focus on a Centrelink, and in particular the age pension. Some of you may be on other pensions such as disability support or New Start allowance, and we can address those questions if they come up, but the focus tonight really will be on the age pension and Centrelink, and in particular we'll focus on the deeming rules and the changes as of the 1st of January, and talk about some of the other parts of that. We could just do a quick poll to just, I'd like to just cover off with a quick poll to see who the audience is and the demographic. So if you wouldn't mind just popping in your age, and then I can exactly know whether I'm addressing people at all ages of the spectrum, or whether it is mainly just those over 60 or otherwise. Thanks very much for completing that. It's about 85 or 90% now voted, so I might just close that poll and just share the results there with you. So on tonight's webinar, we've got mainly people in the 50 to 65, and then those over 65. So with that, I guess I'll focus on those actually potentially going to claim the age pension in the coming years. And about a quarter of you potentially might be already receiving the age pension. So thanks very much for that. Just gives me a good sense of the audience and where I should focus for the rest of the presentation. Now you can ask questions throughout the presentation just using the chat section. I may not always get to it during the relevant slide, but I will get to it at the end if I don't cover it off at the relevant point in time. Just had a question actually from, I think it was someone asking about the deeming rate. I've just lost the name of who that was. But we'll talk about the deeming rates throughout the presentation, so we'll just continue on there. And I'll just take off the poll so you can see the slides, the results. There we go. So really tonight's about how to provide for your retirement, and in particular we're going to focus on the government age pension, but the other sources of income in retirement are your superannuation, and that's made up of both the compulsory and so your 9.5% employer contributions that is going into your super, and your voluntary contributions, any additional contributions over and above that you make. You can also have your own savings and investments. That could be investment properties or shares or other term deposits or other investments. But tonight's presentation really is focusing on the means-tested age pension provided by the government. So what is the age pension, or what age is the age pension, and when does it start? It depends on your date of birth. So if you can see this screen clearly here, you should be able to identify your particular age, and then therefore what your age pension age is. Just to be general, for man born prior to the 1st of July 1952, the qualifying age is 65. For women born before 1st of July 1952, the age is determined on your date of birth. We're almost getting to that stage where a lot of people approaching age pension age are going to be on the similar rate as in the 65 and 65. So there's no difference between men and women. So yeah, just look at your particular age range and you'll know what your age pension age. That's the age at which you're eligible for the age pension. Now, how to qualify for the age pension? Now, there are a couple of criteria. One is that you need to be a resident of Australia, and the qualifying residency period is usually 10 years, but there are some international agreements that are in place as well in Australia. Now, one key thing to consider here is that you don't need, and I had a couple of questions about this, you don't actually need to be retired to access the age pension. You don't need to finish up work at all. So you can continue on working and you might receive a pension depending on the income and assets test. So you don't have to be retired. You can keep on working if you want to. You can scale back your workload. You could work intermittently. So you could go part-time or you could work at certain months during the year. A lot of people, or a couple of clients that I have are working during the election, and so they'll be working intermittently rather than working full-time or part-time. Or you could cease work altogether and access the age pension as well. So there's no one size fits all. It's whatever your circumstances are, and you can work within those timeframes. And in relating to working beyond age pension age, there is actually what they call the work bonus. There previously was the pension bonus scheme that was ceased back in 2009, but the work bonus was introduced to replace that, and that's where you can earn up to $6,500 a year or $250 per fortnight from employment purposes, and it won't impact your age pension. Now, here's an example. So Margot earns $1,300 per fortnight. Of this, $250 per fortnight is disregarded. So only $1,050 per fortnight is assessed under the income test. And so her pension will be reduced slightly because she is working, but because of this work bonus, it won't be the age pension won't be reduced as much. Now, the work bonus is an accumulative thing. So if you do not work, the work bonus is accumulated up to a maximum of $6,500. So if you haven't worked throughout the whole year, you will have accumulated $6,500 balance, and then you could work in 1 week and earn $6,500 and it still not impact your age pension. You can't accumulate more than the $6,500. It is limited to that, and it won't go any higher. So that is the maximum there. An example of that is that Margot's work bonus balance is $500 because she didn't work in the past 2 fortnights or 4 weeks, and she then returns to work and earns $1,000. In a fortnight. So this is in the 3rd fortnight. So she's got $500 from the previous 2 that she didn't work. She's got $250 from the current fortnight, which means that she's only assessed for $250 of income that fortnight. And so it shows that you can actually earn some money and it not affect your pension. That's the work bonus. Couples, it works. You've got individual work bonuses, so you've got $6,500 each. If we just quickly look at an example, we've got Jim and Doris who earn, we've got here $600 each per fortnight by delivering pamphlets in the neighbourhood. They both receive the work bonus, so only $350 of that $600 will be tested because of that $250 work bonus. So hopefully that explains how the work bonus works. And you're clear on how much you can work before it affects your pension. I just had a question from Liz relating to the work bonus and asking, can it be, and it's a good timing because it relates to the next slide, can the $6,500 be from other sources? Could it be another pension, or could it be from owning a business? Well, the answer is no. It's only from employment purposes. That $6,500 can only be from employment purposes, that is salary and wages. So if it is only salary and wages that it relates to. Here's an example. So Bill, he owns a business, and if his company or his private company pays him a salary, then the work bonus will apply. But if he just receives company profits, or if you're, Liz, talking about a form of a pension, that will not apply. It's only relating, the work bonus only relates to employment and salary and wages, and it doesn't apply to profits or pensions or other sources of income. Now, so that's the work bonus. Just we'll explain now how to claim the age pension. Now, there are a few different ways to go about this. One of the easiest ways is to just call the number. So the Senior Australians number is this 132300, and it's good to call it either early in the morning so that you're not on hold for too long. It is generally a bit of a waiting period to get through. Or you can do it online as well. So you can actually either download the forms online, so you can just get the age pension claim form online, complete it, and then send it in. Or you can actually go through the whole process of applying for so claiming the age pension and providing all the income and assets information that they need as well. And so there's a fair bit of flexibility there. You can also, so if you call them, they'll send you out the forms. You can complete them. The date that you call them is the date that your claim is commenced. So say, for example, you call them today, and you complete it's today that your claim has started. So if you're eligible for the age pension, your claim will be today. If you get your forms in within 14 days of the date that you make that call, then any pension payments you're eligible for will commence from today, rather than in 14 days when you get your forms processed. So just be aware of that the date that you claim is the date that you're potentially going to be eligible for the pension payments. It's not the date that you submit the forms. So just be aware of that. And so you could either do that online, or you could do it over the phone, or you can just download the forms, complete them, and send them in, or take them into the office. So there's a fair bit of flexibility there. You do really need to go into an office, though, at some point in time to provide your information, a proof of identity. So you need to really tick all these things off here. So your proof of age, your proof of identity, residency, your income and assets you need to provide as a minimum, your tax file number. But if you don't have all these forms, so say, for example, you've made the claim, you're eligible for the age pension, you turned age pension age, you've given them a call and claimed the pension, and say, for example, you haven't got all your documents lined up, don't delay sending in the documents beyond the 14 days if you haven't got all of them, because if you get your documents in, they'll then come back to say, hey, you need more documents, but your claim will still be valid. It won't have expired. If you wait beyond the 14 days, then your claim will expire and you'll not get your pension payments backdated. So don't delay in getting on those claim forms if you're eligible. You can actually apply for the pension earlier than turning pension age. So you don't have to wait until you've actually turned that age. You can actually apply up to 13 weeks in advance of being eligible for the age pension. So 13 weeks out, but it's advisable generally to do it, say, no more than 4 or 6 weeks out. Because what happens if you're 13 weeks out from turning pension age, you submit your forms, what happens is they process them. They've got a requirement to process them within 28 days, an age pension application. They process them, they reject you because you're not age pension age, and then they'll sort of resubmit the forms again when you become age pension age. It's okay to do that, but generally they suggest holding off until you're a bit closer to age pension age, and then it will all go through without sort of that rejection occurring. Now, when you do receive the payments, they are paid fortnightly in arrears. You can change the date that you actually have started paying on a fortnightly basis. So if you prefer to be paid on Wednesday rather than a Friday, then you can request that change. Generally, they have them directly deposited into your financial institution. there is a system where that Centrelink provide where they can actually pay utility organisations and other bodies directly from your pension. I don't know many people that actually utilise it, so I'm interested if anyone's online who does actually utilise that and finds it beneficial. It doesn't cost anything. It actually costs the institution that you're paying some money, but it doesn't cost you any money. So that's how it works in terms of pension payments. Pension rates and components. So the fortnightly pension consists of 4 different components. Now, it's the base pension. There's a pension supplement. There's a clean energy supplement that is still applied. That was really about providing some form of support when the carbon tax was introduced. If you don't own your own home, you might get rent assistance, and if you're in a remote area, you might get some other payments as well, a remote area allowance. So your fortnightly pension is made up of all those things, although you can choose to take the pension supplement on a quarterly basis rather than on a fortnightly basis. Now, in terms of rates, how much you can be paid, the current rates are for a single person $854.30 per fortnight, or $22,211.80 per annum. For a couple, it's $644 per fortnight each, or $16,744. So that's what the 2 rates are. If you have one spouse eligible and one not, then you'll still get the partnered rate of $644 if you're fully eligible. But generally, if you often people have either income or assets that prevent them from getting the full amount of pension, and so you might get a lower rate than these particular. These are the maximum rates of the age pension that are available to you. Now, so how does that work? Well, so the single rate maximum is at $22,000 here. The couple maximum is at $33,500. So there's a maximum amount that's potentially payable, but then there's an assets test, and then there's an income test. And depending on which one of these 2 tests provides the lowest pension payable, that's the one that applies. Now, we'll talk about this in a little bit more later on. But and your test might change, so you might be asset tested, or you might be income tested at the start, and then asset tested later on. So your circumstances are potentially going to change over time. So let's look at an example of how your pension might reduce because of income testing. So this is trying to explain the income test side of things. We'll look at the income test first, and then we'll look at the assets test. So under the income test, if you're a single person and you earn income over $160 per fortnight, or $4,160 per annum, then the amount of pension that you're paid is reduced by 50 cents for every dollar of income over that $160 per fortnight. And then it cuts out altogether, so you'll be not eligible if you're a single person for any pension, any age pension, if your fortnightly income goes over that $1,868 or annual income goes over $48,583. So it sort of scales back as your income increases. Now, for a couple, the exact same principles apply. So if you're earning per fortnight less than the $284 per fortnight, or $7,384 per annum, then you're going to get the maximum pension. But for every dollar over that amount, each person's pension reduces by 25 cents, or the combined pension reduces by 50 cents. And then once you earn over $2,860 per fortnight, then you become ineligible for the age pension. The annual figures are $74,360. So you can be earning up to, say, $73,000 and still get a part pension if you're eligible. Just quickly check if there's any questions coming through. No, that's good. So that's the income test. Now the question is, what income is included? So just to explain that, it's earnings from employment, and including salary sacrifice. Some people think that if they salary sacrifice some income, then it won't be included in the test. But they changed the rules a number of years ago about salary sacrifice actually being included in the test. So it couldn't actually. It's part of the income test. You can't salary sacrifice and then reduce your assessable income for Centrelink purposes. There's the work bonus that might reduce the assessable income. It includes overseas income. It includes income streams and superannuation pensions. But they are concessionally tested at the moment. We'll talk about that later on. It includes rent from real estate, farm or business income, and deemed income from financial investments. And we'll talk about that in a little bit more detail. But just to touch on it right now, deeming is basically assuming certain level of earnings on your financial assets. So all your financial assets are grouped together. So your shares, your cash, your bank accounts, investments, and loans to others, they're all grouped together. And for a single person, on the first 48,000 is assumed to earn 2%. So it's 2% of the $48,000 is the deemed amount, or the amount that Centrelink assumes that is you earned from those particular assets. The remainder, so the amount over 48,000, is deemed at 3.5%. Now these rates change depending on what interest rates are like. So they're reasonably low at the moment, but they have been higher in the past. For a couple, the same principle applies, but the rate's higher. So 79,600 is deemed at 2%, and the remainder is assessed at 3.5%. Now this is irrespective of actual income. And the idea is that it's not going to deter you from going out and trying to earn the maximum income you can. They're just applying a standard rate so that it's not penalising you if you can go out and find a better rate of return. That's the principle there. Jeff just asked the question, how does the income test relate to the work bonus? So the work bonus reduces the amount that is income tested by that $250 per fortnight. If only one member of couple is age pension age, does spouse income affect eligibility? Yes, how it works is where there's one spouse eligible and one spouse not, they look at your total situation, income and assets, and they divide it by 2, and then they apply the rate based on that. As a minister, is exempt benefits accessible income for pension purposes? A part of a very good question, Ian, and there's a slide that I have on it that I've got from the Baptist Union of New South Wales, actually, that I can provide to you if you maybe email me if you would like that, and it articulates which of those exempt benefits maybe 50% of your benefits are exempt. It explains exactly which of those exempt benefits are accessible for Centrelink purposes and which aren't. Some of them are and some of them aren't. So, but it's not the same as tax. So from a tax perspective, all your exempt benefits aren't taxable, but from a Centrelink perspective, some of those exempt benefits are included there. So yeah, good question, Ian. And here's an example of deeming. So we've got Brian, who is single, and he's got a bank account, and it's got $4,473, and it's earning 1%. So it's just his at-call account that he uses. He's got a term deposit of 72 at 4.5%, or $3,240 per annum, and he's got 28,000 in shares, earning $1,120. So the total return is $4,404, or $169 per fortnight. But what Centrelink does, they don't assume that he's earning $169 per fortnight. They only assume that he's earning $113 per fortnight, because they apply these 2% and 3% rules to these assets. So you can see that that's the difference. What you're earning and what Centrelink assume you are earning is different for those financial investments, those financial assets. That's how deeming works. So we've explained the income test, and hopefully you've understood that to a degree. So depending on how much income you have and how much is assessed from Centrelink's perspective will determine how much your age pension will be reduced. Now, the other side of it is the assets test, and so I'll try and explain that. Just before I move on, quickly, if a couple earns $2,860 per fortnight, therefore no pension payment, do they still get the other benefits, e.g. healthcare card? Yeah, good question, Bruce. We'll come back to that at the end of the session. You can potentially get access to the Commonwealth Seniors healthcare card, depending what your level of income is, and I'll show you that towards the end of the presentation. And it's important when we talk about deeming to understand how that relates to deeming and the changes of the 1st of January too. So tune in at that point in time. So the assets are the things that you own. Different thresholds for homeowners and non-home owners, but the amount of your age pension decreases at a similar rate. So for every $1,000 over the threshold, your pension will reduce by $1.50 per week. What do assets include? They include motor vehicles, boats, cars, house and contents, personal effects, bank accounts, investment loans, real estate, the net value of that. So that means that you take off any loans that you might have. So you might have a $500,000 investment property, you might have a $200,000 loan, so Centrelink will assess $300,000. Farm and business assets, less any loans, antiques, collectibles, and gifting. So we'll talk about gifting a bit later on as well. But if you've gifted money over and above what they Centrelink have specified as the limits, then that will also be included as an asset as well. So how do they value assets? Well, it's the net market value. So motor vehicles, household contents, etc. It's generally your estimate. Now, I was speaking to the Financial Information Services Officer from Centrelink, who I often speak to and is really helpful, and he was saying that if you you don't want to worry about working out what your house contents are worth, then they just assume $10,000. You might have your house contents insured for $100,000, but the amount that Centrelink wants to know is how much would you get for everything that you've got in your house if you just put it all out in the street with a garage sale, and how much would you get for it that next day? It's sort of fire sale cost. So you would never put down more than $10,000, but you can put down, $5,000 and $2,000, $3,000 for those things that you've got in your house, if you think that you could only get that sort of figure for them. Generally, Centrelink don't really, contest that at all. With motor vehicles, they assume they don't often contest that either, really. You could look at Red Book, which basically gives you an idea of what vehicles are worth, but generally you can reduce it below that amount because you might have more Ks on your car, or you might, you might not be able to sell it for as much as what they say on Red Book. So generally, it's your estimate, and often it's not really, challenged from a Centrelink perspective. But basically, you're putting on what a reasonable valuation is. But if you buy a new car, for example, and you spent 20 grand on it, as soon as you drive it away, it's probably worth 15 grand. You couldn't sell it for 20, so you can actually reduce it from Centrelink's perspective in that way. In terms of real estate, the current market value is what's used, and often what they do is they've got an Australian valuation office who actually goes and values your property from Centrelink's perspective. And now I've had one recently where the valuation was actually a lot higher than what it was actually worth, and so we went to and fro between Centrelink to actually get that reduced. It took a bit of time, but we were able to reduce the valuation to the more reasonable value. But generally, they're pretty accurate. I think the Australian Valuation Office, they basically stipulate what your property is actually worth. Financial investments, it's their current value. So if it's bank accounts, you know what their value is. Shares, they can quickly see what the value is there as well. What do you mean by investments, loans in income deeming? I think I was talking about, Bruce, they were talking about assets. not income from memory. I can go back on the slides, but what do I mean by so loans with that was about asset deeming. So if you've got a loan, so you've got $100,000 that you've loaned to it could be a friend, it could be someone that's not related to you. That loan to somebody is an asset for you because they owe you that money. It's your asset. So that would be included as an investment. It's a financial investment, and it would be included under the assets test. Richard asks, I have more than 2 acres, so part of my property will be assessed. Would it be better to sell before I retire and buy a home under 2 acres? Yeah, it's a good question, Richard. There is if you've used that asset for more than 25 years for farming purposes, there is sometimes an exemption there. So I would check out whether that exemption applies. Otherwise, you probably could consider your options there in terms of whether you hold on to that asset, because the amount other than the 2 hectares can be assessed under Centrelink's asset test. But just check that other 25-year rule before you go ahead there. That's for Richard. Are assets divided in half for a couple with only one at pension age? Yes, Randall, that's exactly how it works. So it's divided into, again, add them all up and divide them in 2. Thanks for your questions there. I'll try to keep coming back to questions as you ask them. So that's valuing how you value assets. So what's not included within the assets test, the Centrelink asset test? Well, firstly, the principal home and some surrounding land. As I think Richard was saying, it's up to 2 hectares of private land around that home is exempt from the assets test. I think this is the other item that I was referring to there, that if you've got extended land use, as in you've used it for 25 years for a particular purpose, I think generally farming, then that can be exempt from the assets test as well. But you've got to satisfy that 25-year rule. So your principal place of residence is exempt from the assets test. Other things that are exempt are an accommodation bond for aged care purposes, funeral bonds, prepaid funerals, special disability trust. If you've got a child who's disabled, you can put up to, I think it used to be 500,000, but it's been indexed up. You can put up to like 500,000 or 560,000, I think it might be, into a special disability trust that can pay for the needs of that disabled child, and that 500 or 560,000 is then exempt from the assets test and doesn't impact your things from a Centrelink perspective. That's unique to those people that might have a disabled child. And then the other thing that we'll talk about with an example later on is that a few of you seem to be asking questions about one spouse being eligible for the age pension and one not. Superannuation is not asset tested if you are under the age pension age. So this is a really important strategy for somebody who's satisfied the age pension age and one spouse hasn't. If you hold your superannuation assets in the younger spouse's name before they have reached age pension age, leave it in the accumulation phase of superannuation, it is exempt from the Centrelink assets test. So you could have one spouse getting the full age pension whilst you hold assets in the younger spouse's name. The example here is that you've got Paul, who's 65 and eligible for the age pension, whereas his wife, Gil, is only 58 years of age, and any superannuation money in the accumulation phase for her is not included in the assets test for Paul's age pension. It's a really important strategy, particularly if you're both going to retire. It can be a little bit more difficult later on if you need to keep working, but it is definitely a strategy that should be considered if you've got a significant age difference between spouses. Ian, the next slide I think might be relating to what the threshold is for a home owner single person, so we'll come to that. Super pension balance included in assets. Peter, super pension balance included in the assets. Yes, if you have moved to pension phase, so say, for example, the younger spouse has moved their money to pension phase, then even though they're not pension age, that pension will be included within the assets test. So yes, you're right there, Peter. With the 6,000, I think it's 6,500. I think you've got 65,000 there, Philip, per year income. Is that financial year or calendar? It's an accumulative thing, Philip. So as I explained earlier on, it's not necessarily, well, it's for a year, but it accumulates week on week. So the example that we used previously was that we had a person who had worked for, not worked for 2 fortnights, so for 4 weeks, and they had accumulated $500 of a balance, and then they worked $1,000 and earned $1,000 the next fortnight, and so there was $750 under the work bonus, and only $250 of that was tested. So it's an accumulative thing, not necessarily a financial year thing. So each fortnight that you don't work, you accumulate $250 work bonus up to $6,500. So the flip side of that is that if you earn $6,500 in the first fortnight of getting the age pension, then $6,250 of that is going to be tested for that first fortnight. I hope that answers your question there, Philip. So they're assets that aren't included within the threshold. Now here's to answer the threshold question. So here are all the different thresholds. For a homeowner, so a single person who's a homeowner, the asset threshold to get the full pension is $202,000. Now, a single person can, if they have assets over $771,750, they won't get a pension. They're not eligible because they've exceeded the assets test. Non-homeowner, the thresholds hold higher because you don't own a home. So for a single person, you can have assets up to $348,500, and you could have assets up to $918,000, and you still would get a part pension. Assets over that, you're then prevented from getting the age pension. And then for a couple, similar rates. So homeowner rates and the cutout point, non-homeowner rates and the cutout point. So you could be a couple, own your own home, and have assets of 1.1 million, and still get a part pension, still get the concession card, etc., that's associated with that. Robin's saying, so does this mean that I should convert my super to pension before I apply for the age pension? It's a very good question, but generally it is the case, and particularly if you're eligible for the age pension before the end of the year, it's good to move to pension phase. Yes, Robin, generally it is best to do that. Does superannuation need to be converted to pension phase in order to get age pension? Does superannuation need to be converted to pension phase in order to get the age pension? No, it doesn't. You can leave your superannuation in the accumulation phase as long as you like. You don't need to move to it. The thing is, though, once you are age pension age, it's assessed from an assets test perspective the same. So if you're going to pay 15% tax on earnings within the accumulation phase and pay no tax on earnings in the pension phase, generally you're better off moving to the pension phase. Ian, what is the ministerial exemption? Yeah, good question. I've pulled that from another slide. Both Jeffrey and Richard have asked that question. I was going to investigate that beforehand. I'll have to come back to you on that one. Sorry about that. So they're the asset test thresholds, and they're indexed annually on the 1st of July. So let's look at an example, and often examples help to understand how things work. So we've got Bill and Margaret here who have a home that's on land of less than 2 hectares, so it's totally exempt from the assets test. They've got personal effects of $10,000, a vehicle of $18,000, a caravan of $4,500, a holiday shack of $200,000, bank accounts and investments of $44,500, and $123,000 in an allocated pension. So their assets are $400,000. Now, because they're over those thresholds that we talked about here, they're a couple, homeowner, they're over this threshold, their pension is reduced from the maximum amount, which is 1,288 per fortnight, and it's reduced from an assets test perspective to 1,118 per fortnight. So it's slightly reduced because they're over the assets test. Now, Margaret's working at the moment, and she's earning $27,735 per annum. These investments here are deemed at 2% or $890 per annum, and the allocated pension, it's not deemed, but there's a certain amount of that. She might be drawing, say, $5,000 from this pension at the moment. Centrelink might only be, we're assuming here, only test $2,130. So the total income that's being assessed here is the $30,755, and that means her pension is reduced, their pension is reduced to $839 per fortnight. Now, this is where things change once people, so Margaret stops working. So this next example is this yellow line highlighting here that she's no longer working, and now it changes. So the income test is no longer reducing their pension at all. They're getting the full income from an income test perspective, but now it's the assets test here that's actually causing them to have a reduced pension. So just by ceasing work there, they've got a lot higher pension than they were before. Previously it was income tested and they were getting $839. Now it's changed to $1,178 because the income test is no longer causing them to their age pension to be reduced so much. Stephen asks, is there a difference in treatment between the TTR and a full super pension phase? So is there a difference between a TTR and full superannuation pension phase? Not for those that are over the under the pension age. We'll come to that again when we talk about deeming. So it only really relates to deeming, and I'll explain that when we're talking about deeming, and if I don't, just ask the question again at that point in time. So that's how the income and assets test sort of correlates together. So it's always going to pay the lower amount. Now, this is where we talk about deeming, and this is all about the rule change that's going to occur on the 1st of January 2015. So this is when it comes in. So there's been a lot of commentary about it, and a lot of questions about it, but there are a few people who can be ruled out to be worried about it at all. So if you are not in receipt of an age pension or another government support, so you might be, if you're not in receipt of like a New Start allowance, a disability support pension, or an age pension, or any other government support, and you're not going to be before the end of the calendar year, before the 1st of January 2015, then the changing to the deeming rules you won't be able to do anything about the changes to the deeming rules. You're just going to be caught in the new rules. To actually take advantage of the grandfathering rules that you could potentially do before the end of the calendar year, you actually need to be in receipt of a pension or a government income support. So let me just explain how income streams and deeming work. So currently, income streams such as account-based pensions, term allocated pensions, and annuities are not deemed. So they don't assume that 2% and that 3.5% earnings on them. There's a concessional amount that is applied. I'll try and explain that for you. So the account-based pension is what the Christian pension is. It's an account-based pension. A term allocated pension is an old one that's needed to start before 2007. An annuity is where you actually hand over, say, a chunk of money, and then an institution is going to pay you an X amount for the rest of your life or for a set period of time. You're wearing no market risk there, so you're handing over all responsibility to that institutional life insurance company. They're all types of income streams, and they're not deemed. Previously, previously they were not subject to deeming unless the period of time was less than 5 years. So the life of them was actually less than 5 years. Now, from the new accounts, that are started after the 1st of January 2015, then they will be deemed. They'll be caught up in the deeming process, and that 2% or 3.5% will be applied to them. But accounts commenced prior to the 1st of January will be deemed if you were in receipt of a so they will be deemed, if you were in receipt of a government payment. So the inverse of that is correct as well. So that if you start an income stream before the end of the calendar year, before the 1st of January 2015, and you're in receipt of a government support, age pension, new starts, etc., then you could potentially avoid the deeming rules that commence from the 1st of January 2015. I've just gone backwards. Just one moment. So let's firstly look at how current income streams are considered from a Centrelink perspective, and then we'll talk about how it might impact and change things over time. Just have a couple of questions come through. So George has just asked, what is TTR? If you want to know what TTR is, then I've done a whole webinar on that in July, and there's a recording available, and there's a link available. So if you go to, there's a link on the Christian Super website, but there's also, so if you go to member webinars, and there's recordings there. And there's also a recording if you go to my site as well. You should be able to find it there as well. It's a whole webinar like tonight's webinar. It explains exactly what TTR and how it works. Tony's saying, Gavin, I'm not eligible for the pension because I still work part-time and receive foreign income and pension. However, could be eligible for the Commonwealth Seniors Healthcare Card. Tony, yeah, well, pay attention later on, Tony. That's important. Phyllis, please let the attendees know that information on the new deeming rules were included in the last Living Well newsletter. So if you're in receipt of the Living Well newsletter, then it explains a bit about the new deeming rules. If they don't get this, please contact our member care centre, and we can email them a copy. Also, a copy of the deeming for account-based pensions information sheet is available on the Christian Super website. So more information is available on the Christian Super website. Thanks, Phyllis. That's really helpful. So let's just explain how Centrelink tests income streams currently. So we'll use Bill and Margaret, and we're saying that they currently are in receipt of the age pension. Now, we're saying that I think Margaret here is going to start a Christian pension. So this is a Christian pension of $300,000. Now, she's commencing it at age 65. And she's starting it before the 1st of January 2015. The purchase price is $300,000. So money from these needs to go through superannuation. So she's got to have $300,000 in super and then rolls it to pension phase. Now at 65, her life expectancy is 21.62 years. So what we do to work out the deductible amount for Centrelink purposes is we divide the $300,000 by the life expectancy, and we get $13,870. This is what we call the deductible amount, and this reduces the amount that's tested for Centrelink perspective. So if she's 65, she needs to draw 5% of the balance of a $300,000 pension, or $15,000. Now, if she draws the minimum, or $15,000, then Centrelink is only going to test $1,130, because $13,870 is what we call the deductible amount. So she's drawing $15,000 of income, but Centrelink only tests $1,130 of it. Now, if she chooses to draw, rather than the minimum amount, $15,000, she chooses to draw $45,000, then I've just gone backwards. Then $31,130 is going to be tested from a Centrelink perspective under the current rules. So that's how deeming works currently, and that's why generally, if you've got super money and you're eligible for the age pension, it's best to have it in the pension phase of super. There's this benefit where you're getting this deductible amount, but there's also the fact that it's tax-free earnings on the account and what you draw from it is tax-free as well. So generally in the past and into the future, it's best to be in the pension phase of super. So if you've got money in super and you're eligible for the age pension, then often it's best to move to that pension phase. Now, so what will happen when the new rules apply? So to illustrate this, what we're saying is that it's Bill and Margaret again. They're still eligible for the age pension, but this time Margaret chooses to start the Christian pension with $300,000 at age 65, but she's still age 65 after the 1st of January 2015. And because she started it after the 1st of January 2015, it's the new rules that are going to apply, and the $300,000 pension will be deemed. So we've used the same example as earlier, and she's got some other assets of $44,000 or $44,000. So the first, so $35,000 of the 300 is deemed at 2%, and the remainder at 3.5%. So the income that Centrelink will test under the new rules is $9,974. So you can see the difference. Under the old rules, it was $1,130 if the minimum was drawn. Under the new rules, nearly $10,000. Now, so if you're drawing the minimum pension, then the old rules are better. If you were drawing a larger pension, sometimes the new rules can be better, because if you were drawing $45,000 under the old rules, then you would have been tested at $31,130, whereas under the new rules, then this will apply. So they're just under $10,000. So it's not always going to be more advantageous to be under the old rules. It depends on how much you're drawing, but you can sometimes get around to this by drawing lump sums from it as well. So if you are under the, generally it's going to be best if you can be under the old rules, because of the flexibility of doing lump sum drawdowns. So hopefully that's explained how the old rules and the new rules work, the deeming versus not deeming. Now, those people that can take advantage of those rules, again, I'll just reiterate, are those that are in receipt of a government pension and have moved their money to the pension phase of superannuation. Let's just have a look at an example. So Bill and Mary again, we've got the same example, except we've just increased the allocated pension to $300,000. What happens here is that under the, and this illustrates that there's not going to be, oh, well, actually there will be a slight difference here. Whilst Mary is still working, earning $27,000, under the existing rules, she would have been tested under the assets test over here. So their pension income would have been lowest under the assets test, and therefore received $852 per fortnight. Because this, under the old rules, under the current non-deeming allocated pension rules, that you can be potentially take part of if you start a pension before the end of the calendar year. Whereas under the new rules, and if 10,000 is assessed from the allocated pension that started rather than the 1,130, then the pension will reduce by, I think it's about $170 per fortnight to this amount. So you can see how it can impact. It'll impact whilst Margaret's still working, but then if we look at another example when she stopped working, it won't have any impact at all. So it'll impact if you're assessed under the income test, but if you're assessed under the assets test, so here Margaret's no longer working, it's the assets test that applies, so neither of these actually apply, and therefore whether you're caught in the old rules or the new rules doesn't matter, because it's the assets test that applies. So hopefully that explains how that works. And if you're not assessed under the income test, it's going to be a long time before the deeming of pensions under the new rules, if you're drawing the minimum, is going to, or even if you're drawing higher than that, is going to be of detriment. So here we've looked at if the deeming rates double from what they are as 2% to 4% and 3.5% to 7%, then the amount that is assumed or tested from Centrelink's perspective, and deeming rates change. Deeming rates go up as interest rates go up. So if they doubled, if interest rates doubled and therefore the deeming rates doubled, then it'd be just about $20,000 would be tested from an income test perspective. But look, it still means that you're going to be tested under the assets test, not the income test over here. So they could potentially sell the holiday shack, and then it might actually be the income test that comes into play. But it just shows that it depends on your particular circumstances. But as a general rule, if you can, it's probably better to start an account-based pension with your superannuation money before the end of the year. There is that strategy that we talked about earlier, where if, for example, Margaret was younger than Bill, and rather than holding the money in the pension phase of super, so let's assume that Margaret's not eligible for the age pension, Bill is, Margaret's not. Margaret holds the money in the pension phase in the accumulation phase of super in her name, and then the assets test would then not apply because they're under the lower threshold, and they would get the full age pension. So that just reiterates that strategy of, whilst there's a younger spouse who's not eligible for the age pension, holding money in the accumulation phase of super can mean that you get the person who is eligible could get the higher rate. Actually, this wouldn't apply because you only get half that rate because only one of them would be eligible for the age pension. So I think it's 644 rate would apply there. So, so how do you take advantage of this grandfathering? Actually, I'll just quickly check any questions whilst I've gone through that. I've got a few there. So Sue's saying, so no good starting a super pension before the 1st of January unless I get a government payment as well. I'm not 65 yet. Yeah, if you're not 65 or if you're not eligible for the age pension before the end of the year, end of this 2014, then generally you're going to be caught in the old rules. The only case that wouldn't be the case is if you're on New Start or you're on a disability support pension. In that case, you're on income support, moving to pension phase could mean that you then are under the old rules. But you also really got to consider whether that would then impact your disability support pension and your New Start allowance. It might reduce it. Ian's just saying thanks for the presentation. No need to respond. Thanks, Ian. My wife is working full-time. I'm working part-time and over 65. Does the income test take in salaries divided by 2? So my wife is working full-time. I'm working part-time and over 65. Does the income test take into, yes, both salaries? You're right, Randall. Both salaries divided by 2 is how that would apply. Robin, can an account-based pension be started before age pension age? If so, what are the implications for tax? Even before age pension age, often it's best to move to pension phase because of a couple of reasons. One, that the earnings on the account are then tax-free, and if you're over age 60, what you draw from it is tax-free as well. So often it is good. Check out that transition to retirement, or the I think it's called the retirement planning webinar that we've done previously. It'd be really valuable. John is just asking what is an account-based pension. So Christian Super has 2 types of accounts. A normal superannuation account, and I call that in the accumulation phase where you're putting money into it. Earnings on that is taxed at 15%. There's also an account-based pension, which is when you can move the money in the super account to a pension account, and that's called an account-based pension, and the earnings on that are taxed at 0% tax rate, so you don't pay tax on earnings on that. So that's the benefit of being in the pension phase. You can also access some of the money in it as well. So that's an account-based pension. It's a form of income stream. You need to pay some of the money out. Check out that retirement planning webinar, John, to learn a little bit more about that. So how to take advantage of grandfathering. And I'm aware that we've just ticked over an hour. Sorry it's gone a bit longer than planned. but it is a new topic, and I haven't addressed it previously, so I wasn't fully aware of how long it would take. We're nearing the end of it, just a few important things to cover off. So how to take advantage of grandfathering. If you do need to go, we do have a recording, so you will be able to access that if you do need to go now that it is ticked on past the hour. So to take advantage of grandfathering, you need to ask, are you age pension aged? So if you are age pension aged, then you could be eligible to take advantage of the grandfathering. Are you receiving income support? So are you receiving either New Start, disability, or the age pension? Or will you possibly do that before the 1st of Jan 2015? If you've ticked yes to this or and this, then if you commence an account-based pension before the 1st of January 2015, then you could take advantage of the grandfathering. So have the old rules apply, the concessional deductible amount apply, rather than deeming applying to your account-based pension. So your account-based pension will not be deemed, and it will be grandfathered under the existing rules. So that's the requirement there. Now, if you have too much, if you're eligible, you're age pension age, and you are eligible, but you're not eligible for the age pension because you're earning too much, you've got too much assets, then still tune in as well, because you could actually be eligible for the Commonwealth Seniors Health Card, and there may be a benefit for you to starting an age pension before the end of the year as well. So just tune in if that's your scenario. So how to maintain grandfathering. So say, for example, you're on the age pension now, you've got money in the pension phase of superannuation, you're therefore caught in the grandfathering rules. So how do you make sure that you don't, in the future, after the 1st of January, exclude yourself from grandfathering? So stop that grandfathering applying. So what you need to do to maintain the grandfathering is to maintain your account-based pension. So don't close it, don't roll it over to another account, don't reboot it. Reboot it means combine it with another superannuation account, because then it changes the account and it will be then exempt, then it will be caught under the new deeming rules. So you can't really change your account. You can't change product providers. So if you do have other money out there or other product providers that you're not comfortable with, and you just want to move it over to that, potentially to a Christian pension account, then do it before the end of the calendar year. Otherwise, there's going to be a disincentive for you to move in the new from the 1st of January 2015. You also, if you want to maintain your access to the old rules under the grandfathering rules, you need to continue to qualify for income support. And in most cases, we're talking about the age pension here. But if you for some reason, you might just have done some part-time work, you do not qualify for a single payment of the age pension, then you immediately lose your grandfathering. So it's a little bit tricky. You could actually be earning more, and it might then mean that you lose your grandfathering. The other thing you can do is that if you are a couple, is that you can set up a reversionary beneficiary. So what that means is that when you start an account-based pension, you've got about 3 main options with directing your money when you die. So say, for example, we were talking about Margaret. She's got $300,000 in an account-based pension. When she started that pension, she had the option to set up a reversionary beneficiary. And usually the reversionary beneficiary is your spouse. So Margaret, when she started her account-based pension, could have said, I wanted to direct my money to Bill when I die. And if that's the case, and it's set up as a reversionary beneficiary, it will automatically go to Bill on Margaret's death. If you do have that set up, then there's no change to the account, and so when you die, the account continues on, and the grandfathering will still apply. So there is an incentive and worth considering. If you've got an account-based pension in place, you've got a Christian pension set up, and you're a member of a couple, and you've not set up a reversionary beneficiary, you could restart that pension, just to complete another pension application form, set up a reversionary beneficiary, and then it's more likely that your spouse is going to be able to take advantage of the grandfathering rules later on. The other couple of options are a binding nomination. So you can say, rather than a reversionary beneficiary, a binding nomination, which means that the Christian Super, the trustee, needs to direct it to who you specify, and generally it's your spouse. Or you could make a preferred nomination, and then they consider it, but they still need to make a call on it. So they're the couple of different ways that you can set up your pension. Just this last thing here is saying that even if you have a reversionary beneficiary in place and it reverts to your surviving spouse, sometimes because then you're on single rates rather than couple rates for Centrelink purposes, and your assets are higher, you sometimes get excluded from the age pension because you've now tested on a lower assets testing, so you sometimes end up not qualifying anyway. But that's how you maintain your grandfathering. Just got a couple of questions coming through. Randall saying, thank you, my pleasure. Ulrina, I have taken early retirement at 63. I have moved my super to an allocated pension phase. Will that be of any advantage to me? Not in terms of deeming rules or access to the Commonwealth Seniors Healthcare card, because you're under age pension age. If you've not reached age pension age, it doesn't matter if you've moved to an allocated pension. It's not going to be advantageous to get caught under the grandfather in the old rules. You're going to get caught in the new rules. The new rules will apply to you. So that's how to maintain grandfathering. A few frequently asked questions are, my partner is on a pension, so age pension, and has an income stream before the 1st of January 2015. I have an income stream too, but I won't be on pension until 2016. How will the measure affect me? Well, what happens here is that your partner's income stream will be deemed from the 1st of January if you are receiving a low-income healthcare card. His income is grandfathered for both of you in 2016, but your own income stream will be deemed from 1st of January 2015. So the person who's on the age pension, if their pension has commenced before the 1st of January, it will be under the old rules. But the spouse who's not going to be at age pension age until 2016, they'll be under the new rules. So one spouse's account will be under the new rules, one will be under the old rules. So that's a question that commonly comes up. Another question that does come up sometimes is, will any customers have their rate reassessed and changed on the 1st of January 2015 due to this measure? Well, but perhaps. Although no current customers will have their rate reassessed and changed on the 1st of January due to their own income stream. So if you've already got an income stream in place and 1st of Jan ticks over, that's not going to mean there's going to be a change. But if there's a non-customer partner, so there's a younger spouse who has an income stream, then this will be deemed, so there could be a change. So this is really important. If you've got one spouse on the age pension and one spouse not on the age pension, then you really need to consider holding your superannuation money of the younger spouse in the accumulation phase. Or the alternative strategy is that if you do have access to the younger spouse's money, in that they've either they've satisfied a condition of release, you could actually pull out the younger spouse's super, put it into your bank account, and then put it into the older spouses if they're eligible to put it into super, back into super. You could put it into the elder spouse's name in super and move it to pension phase and have a higher amount caught under the old rules rather than the new rules. So a couple of strategies to consider there. Richard's just asking, how do I know if my wife is a reversionary beneficiary? She is nominated as a 100% beneficiary. Yeah, if she's nominated as a 100% beneficiary, Richard, generally it's not then a reversionary beneficiary. It needs to specify on your member statement that it's a reversionary beneficiary to your spouse. So it needs to say reversionary beneficiary, not just 100% beneficiary. That's the difference. And you can only do it at the start of the pension. So if you've got a 100% beneficiary, so it's a binding nomination or a preferred nomination, then the only way to change that is to complete a new application form. It actually restarts it. And if you want to do that, then it's good to do it before the end of the calendar year, before the end of December. Robin asks, is the assets test affected if the home is sold and purchase of another doesn't occur immediately but in a couple of months' time? And no, it doesn't. You can actually hold the funds or the proceeds from the sale of your home for up to 2 years, and it will be excluded from the assets test. It won't be excluded from the incomes test. So it will be actually deemed, but it's not considered an asset for that 2-year period. You need to specify to Centrelink that that's what's happening, but it can be exempt from the assets test for up to 2 years before you, if you haven't bought a home within that 2-year period. Good question, Robin. So there's just a couple of grandfathering. Now this is for people who are, they're age pension age, but they've either got too much assets or too much income to receive the age pension, but they still might be eligible for the Commonwealth Seniors Health Card. There's no assets test for the Commonwealth Seniors Health Card. It's just income tested. And so you've got to be age pension age, but adjusted taxable income for a single needs to be below 51,500, or as a couple 82,400. Now from the 20th of September 2014, these incomes limits are going to be indexed up. But the issue is that previously, and I'll just check whether it's on the next slide. Yeah, previously, the income that you derived from account-based pension wasn't included in the test. So it wasn't included in this figure here. So we're talking about Margaret with 300,000 generating 15 or drawing 15,000 from her pension account. None of that was tested under this threshold. None of that $15,000 she was drawing from our account-based pension was tested under this, or she was actually in a couple, so it was under this. None of it was tested, but now they're proposing to change that, and so they're going to include this income, so include income deemed from account-based pension. So this is new rules. So if you are eligible for the Commonwealth Seniors Healthcare Card before the you don't have to be eligible for the age pension, but you're eligible for the Commonwealth Seniors Health Card before the end of the calendar year, then it's well worthwhile moving your, if you're not already, moving your superannuation money to pension phase for the grandfathering that applies pre the 1st of January 2015, because you'll avoid deeming, and therefore your pension won't be added onto this threshold, this 51,500 or 82,400 threshold. I hope that makes sense. If that doesn't make any sense, just ask the question. But it's just for those people who aren't eligible for the age pension because they're earning too much or their assets are too much, but are eligible for the Commonwealth Seniors Health Card. It could be advantageous to be under the old rules and therefore starting a pension before the end of the year, end of the calendar year. Just quickly check the questions. Where do I view previous webinars, Tony? I'll go to further information on the last slide, or second last slide, and it'll explain where to find that at other webinars. Robin, thanks, Gavin. Having difficulty with audio, so I'll sign off. Appreciate the information you've shared, Robin. Many thanks. Is anyone else having problems with the audio? Hopefully not, but just let me know if you are. Randall says, if I earn income and my wife earns income, but I am only the only one of age pension age, is total income divided by half for determining the health card? If I earn income on my wife earns income, but I'm only one of pension age. Yeah, exactly. So that should so it should be divided by 2 again. So it'd be actually no, it's a combined. It's under that higher threshold. So your income would need to be sitting under this couple's combined income here of 82,400 for that to apply. Tony saying, thanks, very informative. My pleasure, Tony. So after January 2015, would it be worth not having super or account-based pension and just having money in the bank, because that would be assets but no income to deem? No, Liz, that's totally incorrect, because financial assets are going to be deemed like account-based pensions are going to be deemed. So it doesn't matter if you're holding the money in the bank account or holding it in a pension phase of super, it'll be deemed in a very similar way. But the benefit of being in the pension phase of super is that there's no tax payable. You might not have tax payable on your money in the bank if it's outside of super, but you do get the benefit, the benefit of ensuring that's the case by being in pension phase of superannuation. Peter's just saying audio cut out for 30 seconds on a few occasions. Oh, thanks, Peter, for the feedback there. That's disappointing that it has done that. I'm not sure. It can be a range of issues. It can be my end. It shouldn't be my end because I'm going through a phone line, so it shouldn't actually be my end. But it could be your internet connection. It could be a range of things. So apologies for that. If you've missed something that you want to get hold of, then there's a recording that we'll send out to you afterwards. So that's all about the Commonwealth Seniors Health Card. There also is a pensioner concession card. All pension recipients get that, and the primary entitlements are healthcare, health benefits, pharmaceutical, transport discounts, household bills or utility bill discounts, and there's some other informal like membership, sports clubs, entertainment, etc. You can get discounts through that as well. We mentioned earlier about gifts and how that comes into play. So you can actually gift money, but if you gift over the thresholds, then it can be maintained as an asset for 5 years. So you can gift as a single $10,000 per annum per financial year, or as a couple, it's still only $10,000 combined for the financial year, or $30,000 in any 5-year rolling period. So you could give $30,000 for 3 financial years, but for the next 2 financial years, you couldn't give without it being included on your assets test for the next 5 years. So excess over limit is assessed as an asset for 5 years. So it remains on, whilst you don't have it and not earning any interest or income from that money or that asset, if you've gifted it, it will, over those limits, it will stay on your Centrelink assessment for that 5-year period. And it includes 5 years prior to your pension claim. So if you're eligible for the age pension at 65 and you're only 59 and you're keen to gift the money to your kids because you want to help them buy a house, for example, it's good to do it 5 years before being eligible for the age pension, because then the 5 year will so say, for example, you're giving a child $50,000. If you do it 5 years prior to turning age pension age, then it's not going to come into play. You've gifted it 5 years earlier, and Centrelink won't be worried about it at all. Some people try and gift money to increase their age pension, and in the past, when interest rates were higher, that was not necessarily the most logical thing to do. So if you gifted $10,000, you effectively reduce your assets by, if you're assessed under the assets test, it reduces your assets by $10,000, and you might get $390 more per annum in age pension. But you could actually have that money in the bank account earning 5.5% interest and therefore earning $550 per annum. So the concept here is that why would you give 10 grand away if you could earn $550 in interest? So you're earning more than 390. But the thing is, interest rates are so low at the moment that you sometimes struggle to get more than 3.5% on your $10,000, which is only $350, and so therefore it sort of does come into play that if you were keen to gift money to your kids, then or to an organisation or something, then you could actually increase the amount of your total earnings if you're only earning 3.5% on your money The drawback is that if interest rates go up to 5% in the near future, which we're at record lows, then you can't then change your mind and get your 10 grand back unless you give it to kids and they're happy to give it back to you. So just a little bit more information there on gifting and how that works. For those people who are going overseas, I did say that I would articulate what happens here. So I did mention to Peter Murphy at the start of the session that if you do move overseas and you've moved over, or you've been living overseas for 26 weeks, then if you're overseas temporarily and it's greater than 6 weeks, then the pension supplement reduces. Now, the amounts that it reduces, if you're a single, it'll I just got to get rid of this aeroplane. Actually, it's in the way. I'll just delete that. So if you're single, it'll reduce from this is a per annum figure, 1,651 per annum to 574. So if you're gone for 7 weeks rather than 6 weeks, it's going to have very little difference. It's not really much at all. But if you're permanently overseas, then you're going to get slightly, you're going to be nearly $1,100 less per annum if you're permanently overseas because the pension supplement reduces. For a couple, it reduces from the standard rate of nearly $2,500 to just under $1,000. So that's the pension supplement. That's the annual figures. But if you've been over, or once you return to Australia, it goes back to the standard rate of pension supplement. But if you're overseas for more than 26 weeks, how much of the age pension you continue to receive is dependent on how long you've been in Australia prior to being age pension age. So if the rule now from the 1st of July 2014 is that you would still get the full age pension less the supplement, or getting the reduced supplement, if you have been of working age in Australia for 35 years. Prior to the 1st of July 2014, if you moved overseas permanently then it was only a 25-year requirement to continue to receive the age pension whilst you're overseas. So I hope that explains that. Let me know if you've got any questions about that. And for Tony, I think who might have asked the question about where I can get further information. Like Phyllis said, call the help desk. You can go to the Christian Super website, which has got lots of information about deeming and a range of things. Christian Super's website has also got the member webinars. So there's a link to the member webinar. So it's christiansuper.com.au/member-webinars. You can get, if you want to lodge a query through cornerstonewealth.com.au, I'll then contact you. Can give you some, personal advice. You can also call our 1300 number, so 1300 275 428. And Centrelink has a fair bit of information as well. So you can look at their website. They've got lots of information on there, humanservices.gov.au. There's a Senior Australians line of 132300. There are some apps as well. So if you're into apps, then there's the Express Plus Seniors app. Just search on Centrelink on your smartphone app store. And there also is a rate calculator. So some people say, what would happen if I worked? How much would it affect my pension, etc.? You can go to this link here, or just go to the humanservices.gov.au website and type in rate estimator, and it'll take you to some calculators. You've got to put all your details in, but it will just help you if you want to jiggle around some numbers and say, well, what if I worked this much? How would it affect my pension? That can be of assistance as well. So try that. And that's it for the content. I'll just continue to answer any questions that you may have. If anybody wants to ask an audio question verbally, then I'm happy to do that as well. Open the lines for you. I'm in Germany and thanks, Richard. We didn't catch that earlier. I'm in Germany and have no issues with audio. So thanks for letting me know, Richard. That's great to know that it potentially was on Peter's side of things, not my side of things, that the audio wasn't working. I think you might have been the furthest away. We had that question just as people were coming online, working out who was the furthest away. So I think you might have won that won that race. Jeff saying, thanks, Gavin, my pleasure. Thanks for the seminar, Liz, my pleasure. Thanks very much, Stephen. You're more than welcome. So thanks very much for your participation tonight. Continue to ask questions. I'll stay online as long as there's more questions, and I'll try to address it. We will send out a recording for you, so we'll try and get that out as soon as we possibly can. I think also there's a questionnaire at the end once you log off, so appreciate if you had any feedback, please provide it there, or you can contact me on the email address. Richard's saying thanks. It has answered many questions. My pleasure, Richard. Thanks for the seminar, Peter. My pleasure. Great seminar. Thanks, Audrey. Thanks a lot, Gavin, Neil. Thanks, really. The feedback and interaction just makes it so much more enjoyable for me, and hopefully it addresses your needs as well. So thanks for so much interaction during the session. It made me go a little bit longer than the hour, but often it's better to go a bit longer and address people's questions than to have a monologue. So thanks again for all the interaction. Trish is saying good night. Thanks, Trish, for your participation. Bruce is saying I'm negative gearing rental income. How does that affect income testing? Yeah, it generally is the negative gearing is generally added back. So if you're negatively gearing it by say 10 grand a year, that 10 grand is then added back to your income test. So it can actually have a negative impact from an income test perspective. But you could run that through that'd be a good case to run your particular scenario through that Centrelink calculator. We've got all software that we use, but if you want to try and do it yourself, you could run it through that rate estimator through Centrelink's website just to see how your particular scenario might be impacted there. Richard McAllister, just the ministerial exemption. Yeah, I'll follow up about that. Thanks, Richard. I'll send that out in an email maybe. I think 2 of you have asked about that. John Webster, the point of gifting to children is to give money before dying in your 80s or 90s. The point of gifting to children is to give money before dying in your 80s or 90s. Yeah, I don't disagree. I think that's great. If you've got a question there, just reiterate that, John. I'm not. It comes off their inheritance. Yeah, that's fine. It comes off their inheritance, but I was just talking about it from a Centrelink perspective, in that if you go over that $10,000 per year or $30,000 over 5 financial years, then it stays on your Centrelink assets for that 5-year period. So I think I was talking about it from a Centrelink perspective. So hopefully that's addressed your question there. But it is good to pass. If you're able to and it doesn't impact you, then helping the next generation before you've died is often a good way to go. There's a guy called Ron Blue who's written a book called Splitting Heirs, and he calls it got this catchphrase of do you give in while you're living, so you know where it's going. And another one is pass on wisdom before wealth. So yeah, it's all about, if you want to sort of get into the, I guess, Christian passing on assets to the next generation sort of questions, then the book is Splitting Heirs by Ron Blue. Really good one if you want to delve into that a bit more. Phyllis, thanks for the feedback there. Appreciate you being online. It's great to have you participate, Phyllis. That's great. Robert says, yeah, thanks. So I'm 64, my wife's 63 and never worked. Can she open up a super account? Yes. Yeah, as long as you're under 65, you don't have to satisfy a work test to open up a super account. You can put money into that account. There are 2 types of contributions that can be made. One is a non-concessional contribution, and that limit is $180,000 per year. So you could put that money into an account for her, and or she could, depending on how much money she's earned, she could actually make what we call a deductible contribution or a concessional contribution, and the limit for that for somebody over 50 is $35,000. So, yeah, that certainly can happen. John says, thanks heaps. My pleasure. Thanks for being on board. It comes off, that's John. Okay, thanks for the info. Bye, Gavin. Bruce, my pleasure, Bruce. Peter's asking, is any tax payable on super funds passed to beneficiaries of a will? It depends, Peter, on whether they are financial dependents or not. So, and what the tax components are within your fund. So if your superannuation is generally made up of employer contributions, so the superannuation guarantee, salary sacrifice contributions, and the like, then those components are generally called taxable components. And if that money was to pass to a spouse, the spouse is financially dependent, and it would be tax-free. If it passes to adult, non-financially dependent children, then there's potentially 17% tax on those taxable components when it passes to them. So there is a strategy called a cash-out recontribution strategy that you could potentially take advantage of, that eliminates the taxable components within your fund, and then when money passes to financial non-dependents, like adult children, then there's no tax payable by them. But it depends on your circumstances as to whether that can apply. There is a good website. Actually, I've got on my website a cash-out recontribution page I've just started or just put together. I'll just quickly find. I can't remember the actual. I think it was called Cash Out Recon or something along those lines. It might be recontribution strategy. I'll see if I can find it for you anyway. But there's a link to Cash Out Recontribution strategy that I can provide, and it just explains it. Otherwise, it's under the if I go to there it is, Cash Out Recontribution strategy on the website there. So it's the link is cornerstonewealth.com.au, Cash Out Recontribution strategy with dashes in between all the words. Hopefully you can see it there. But that video here, there's a video there that explains the Cash Out Recontribution strategy and how that works. So hopefully that answers your question, Peter. Thanks for the question. Richard's just asking, I'm on a supported income with no fixed amount per month. Supported income. How does this affect receiving a part pension? Supported income with no fixed amount per month. How does that receiving supported income? Do you mean supported income as in you're a missionary and you're getting support that way, or do you mean you're getting like a salary continuance payout, or what's this? I don't really need a little bit more information there, Richard, to be able to respond to that. So maybe type that in if you can. What's your supported income? What sort of supported income is it? Gerald's just saying thanks for the webinar. My pleasure, Gerald. Thanks for being online. It's much appreciated. Good night, Richard. Thanks for being online. I appreciate you being online. So if you've got any other questions, pop them through now. I've just, Richard, I think somebody had their hand up. You can raise your hand. I've just put all the hands down. But if you wanted to actually ask an audio question, I'm happy to open up your line if you've got a microphone there on your computer or you're on via the telephone. I'm happy to open up your line. To do that, you would need to raise your hand. I think there's a little hand on the side panel you can raise. Um, Otherwise, I'll just keep asking questions via the chat section. Richard is just clarifying, it is dependent on how much is given, so it's by donors. So you're getting donor support. Yeah, it's a tricky one, this one, but often the money that you're receiving as support would be considered as accessible income from Centrelink's perspective, and depending on how much that is, it would depend on how much your age pension would be, or your pension amount would be. Yeah, so it'd be under that similar. I would suggest that it would be just accessible income from Centrelink's perspective, and depending on how much income there is, it would reduce your pension by that amount. Robert's just asking if I open an account for my wife and I already do salary sacrifice, so that salary sacrifice plus employer contributions equals 35,000. Can I put money into her super account? Does it come off my taxable income? A lot you're thinking there, Robert, but no, you can't. Your limit is $35,000. She's got another $35,000 limit, but it just comes off her taxable income. So if she's not earning income, there's no reason to, it's not worth, you can't really, there's no point in putting those types of contributions in. What you can do, if there's a reason to do it, is you can split your contributions over to her account. So of your $35,000, 15% contributions tax is deducted from that. So about $30,000, the remaining amount, the other 85%, around $30,000, can be transferred over to her account under splitting rules, but it still doesn't increase your contribution limit. It doesn't increase that at all. So there are the reasons you might want to do that is because she might be older and therefore she'll get access to it tax-free earlier, or she might be younger and you want to start to move the money across to her account prior to you reaching age pension age, so that it's a non-assessed Centrelink asset. So there's a couple of reasons you might use that splitting, super splitting, but it doesn't increase your $35,000 contribution limit at all. It still stays the same. Because you're using your $35,000 contribution limit to get it in there. It doesn't impact her contribution limit by moving it across, but it doesn't increase yours either. Good question. I like your thinking though, Robert. Thanks for the useful information. Good night, Alrina. My pleasure, Alrina. Hopefully I've pronounced your name there right. Yeah, thanks for your participation. It's great. Oh, thanks, John. You said the Cash Out Recontribution Australia was on my homepage. Easy to find. Thank you. That's great. Richard, thanks. My pleasure. Thanks for the webinar. Always good. Thanks, John. Appreciate the feedback. Peter's saying, thanks. So we have probably progressed beyond most of this information, but great, innovative. I think that might be. Thanks, Peter. My pleasure. Yeah, it's hard to meet everybody's particular needs because everyone's at different levels. But hopefully I've met the majority of people's needs. Sometimes I feel like I get too complex. Sometimes I feel as though things might be a little bit too simple. But yeah, hopefully I've met people's needs. All right. Rosalie's just, I just checked my emails, and Rosalie sent through a question. It took a little while to download and missed the first 10 minutes, so she emailed a questionnaire through. I'm not sure whether you're still online, Rosalie. Yeah, you might be actually. So I'm just going to answer your question here now. I'm a single lady working full-time during turning 59 next month. I would also like to retire when I turn 61 and use my superannuation to pay off most of my mortgage. Can I do that? And then can I work part-time or casual? I'm not sure of the rules around this and can't seem to find out. Also, at what age can I get the age pension? Yeah, I did address that at the start, but I'll go back, Rosalie, and I'll respond to each of your questions. So the easiest one is, at what age do you access the age pension? That was answered probably whilst you were still downloading the app. So depending on your age pension, depending on your date of birth, it'll be a different age pension age. So if you're trying to do my sums, if you're 15, just look it up yourself. Check out which birth date relates to you and you're female. So check out the rate that applies to you, and that's your age pension age. So that answers one of your questions. When are you eligible for the age pension? The other question is, I would like to retire when I turn 61 and use my superannuation to pay off most of my mortgage. Yeah, you need to satisfy a condition of release to fully access your superannuation money. You can access it partially when you reach your preservation age. Now, I might need to open another presentation to answer that question. A lot of this information is well covered in that retirement planning webinar, but I'll see if I can find it for you since you're still online. So, just trying to find. So, when can you access your question? Really, is when can you access your superannuation? Depends on your preservation age. So, if you were born, but depending on your date of birth again. It specifies your preservation age. Once you reach your preservation age, which I would assume that you will have already, you can actually access your superannuation money. You can move it to pension phase and draw up to 10% of the balance. Whilst you're under 60, it's often best not to draw the maximum amount because it's partly taxable, depending on the components. But once you have reached 60, then you can draw, the full 10% of the balance tax-free. You start to pay down your mortgage as soon as you turn 60, possibly. But then, if you change employment after turning, or cease a form of employment after reaching age 60, then you've satisfied a condition of release. You can pull all of your money out, or as much as money as you want, and you can pay off your mortgage. So, if you retire at 61, that satisfies the condition of release, and then you could pull out your money and use it to pay off your mortgage. You could then go back to work and work part-time or casually. Or you don't need to actually have to retire. You could actually just change employment. You might cease one job, start another job. That would satisfy a condition of release if you did it over age 60, and then you would have full access to your money as well. And there's no problem then continuing to work after that as well. So hopefully that's answered your question. Let us know via the comments section of the webinar software if you've got follow-up questions to that. Okay, it seems like we've just about finished up with all our questions. So thanks very much for all of your participation. And yeah, just email if you've got any further questions. Good night, and thanks for your participation.